Hello, everybody. How are you doing? Welcome back. All right, let me just get connected up here to make sure that we are everywhere we are supposed to be. How is everybody doing? How is your Saturday going so far? Let's see. Okay, I want to make sure I'm giving everybody ample time to get in, so that they don't miss any of this important information, these gems that we are giving out on today. And if you happen to scroll by and if you're not having time to stay for the entire webinar, then if you would just drop your email below and you would get the replay, all right? Because we do have a lot of information to cover today. And so if you just want to drop your email in the comments, I'll be sure to send you out a replay, all right? So let me see here. Okay. All right, so we are going to go ahead and get started on this morning. And again, I am TK Barlow. I am the owner of the Barlow Group Tax and Accounting Firm. And so today we're going to be talking about 10 strategies that you can put in place right now to make sure that you are maximizing your tax deductions and that you get your business tax time ready, okay? So I am going to go ahead and share my screen here. All right, so let's get started. So 10 strategies to maximize your deductions and get your business tax time ready. All right. So again, my name is TK Barlow. I am the owner of the Barlow Group Tax and Accounting Firm. I am a native of Atlanta, Georgia, and I find joy in spending time with my family, as well as being able to encourage entrepreneurs such as yourselves to really live beyond your dreams, and how to do that. With paying the minimum amount of taxes possible, right? So let me get my screen ready here, how I need it to be. Hold on one second. Okay, here we go. All right, you guys can still see me, right? Okay, all right, great. So first thing we want to do is we want to be able to understand our business entity, because oftentimes we have, clients come in the door, and in order for you to get your taxes prepared properly, we have to know your business entity. And so sometimes you may have people set up your business for you, and you don't necessarily get all of the paperwork back that you need, but you need all of those documents that they filed so that you have confirmation on what type of business entity that has been filed on your behalf. All right. So understanding your business entity. So we have a sole proprietorship. So this is majority of how business owners start out. They're usually a sole proprietor. Now, when you are a sole proprietor, you should also note that the tax form that is going to be used if you are a sole proprietorship is going to be Schedule C. All right. So there's no separate business tax form that is going to need to be filed as long as you are a sole proprietorship. You're just going to have that Schedule C, and that Schedule C is going to go alongside your personal taxes, which is your 1040. Okay. So the due date for your sole proprietorship is going to be April 15th. That's the same date as your personal taxes, because again, these two things are going to go together. All right. So secondly is the single member LLC. You're still taxed as a sole proprietorship, but what is the difference? The difference here is that you are saying for your business, you are separating your personal liability. All right. So if you are a sole proprietorship, And if in the case you get sued, your personal assets would be, you know, would be something that could be taken away because you are a sole proprietorship. However, when you go ahead and make your business an LLC, a limited liability company, then you have limited personal liability. So that means in the case if you were ever to get sued, God forbid, that your personal assets would be protected. All right. So and a lot of time people, you know, we ask people, well, is your business incorporated? And they say, yes, I'm an LLC. But the truth of the matter is LLC stands for limited liability company, not corporation. All right. So with an LLC, you will also file the Schedule C form too. So that would go alongside your personal taxes, just as your sole proprietorship is going to go on your Schedule C. Your single member taxes is going to go on your personal taxes with your LLC as well. Okay. And then the due date for this is going to be April 15th, just like your sole proprietorship. And so I want to show you what the Schedule C actually looks like. So bear with me for a minute. Okay, so this right here is a Schedule C. It is the profit and loss from your business. And what happens is all of your information is put here. And then your income that you brought in would be filled in here, and then all of your expenses. So these are the things that are going to be tax deductible from your business. Okay, so you have advertising, your car and truck expenses, any type of contract labor, interest, legal and professional services, office expenses, rent, supplies, wages, all of those things would go in here. So that's why it's really important for you to track your expenses and your income throughout the year, because as a sole proprietor and as an LLC, this Schedule C would need to be completed. Okay. All right. Let me see if I can jump back into my presentation. All right. So we're back. Okay, so then we also have the partnership. That is another business entity. You would file your partnership taxes on a 1065. Basically, this is the reporting information. You're giving the IRS everything that has happened within your business as far as your income and your expenses as well. So when you have a partnership, you're going to file your business taxes and your personal tax filings. So there are two tax filings that you have to do when you have formed a partnership. Okay. And these taxes are going to be due on March 15th. Now, if you are an S Corp, then you're going to file Form 1120S. Okay. So again, these are two different tax filings that you would have to do. You have to do one for your business, and then the other is going to be for your personal. And both of these are actually due on March 15th. Now, you don't have a Schedule C that you report all the information on. Instead, you have a K1. Okay. So let me show you what the K1 looks like as well. Let's see here, K1. Okay, so this is what your K1 looks like. This is for, I believe this is for the partnership, but they're very similar in how they're set up. And so what you would do is, depending on how many partners it is, if you're the only person in your S Corp, then you would get a K1 just for you, reporting all of your losses and all of your income for your percentage as a shareholder. But if you are a partnership, you know, it's going to be two or more people in that business. Each shareholder would get their K1 reporting how much percentage of the income and how or the loss and everything that has been reported back to the IRS. So if you are an S corp or a partnership, you would get a K1, and then the K1 information is going to be reported onto your personal income. Okay. Okay. Let me see if I can switch back. So that is what a K1 looks like if you are a partnership or if you are an S corp. All right. So another thing to note is also when you are running your business, you also have to report payroll taxes. So if you have a payroll system that does this for you automatically, like ADP or the QuickBooks payroll, all of those are going to do this for you. But if so happen that they're not, then you need to know that you have to report the quarterly taxes, the payroll taxes for each employee. Even if you happen not to run payroll for whatever reason, you still have to submit these forms because they want to know, okay, well, how much did your business make? They want to know all of your business in details. All right. So if you are on payroll, and if you have skipped a quarter for whatever reason, you still have to submit the information. All right. So keep that in mind as well. Okay. And the next thing, another way for you to maximize your deductions and get tax time ready is maintaining proper bookkeeping. So this is something that I always talk about and I like to share because it is so important as an entrepreneur for you to have proper bookkeeping. So many times people ask me, they say, TK, when should I start my bookkeeping? And the truth of the matter, what I always say is that you need to start bookkeeping the first day you make your first business transaction, right? So the first day you swipe your card for a business expense is the first day you need to start your bookkeeping. Now, when do you need to hire a bookkeeper? That is something on a different level. That will be depending on your budget. Is your budget saying that you are able to hire a bookkeeper? If not, then that means that you have to go the old school way, right? So you can either use your spreadsheets, you can use a good old note paper and pad. There are a lot of low cost bookkeeping apps that you can use as well to try to keep your books together, but you need to be able to track your income and track your expenses and be very detailed about it as well. All right. Because there are a lot of benefits when it comes to maintaining your books. First of all, you're going to be able to get the financial visibility that you need. A lot of times, I'll ask entrepreneurs, well, do you know how much you made last year in your business? Do you know how much you made last month? Do you know what your average profit is monthly? So these are questions that you should really know about your business, and bookkeeping and managing your books accurately. This is going to give you those answers that you need. All right. So with having proper bookkeeping, you're going to be informed about what your numbers look like in order to make decisions in your in your business. So if you're looking to, purchase new equipment, you want to purchase a new machine, you want to hire an admin, by you knowing what your bookkeeping is looking like, you know your numbers. So if you kind of know what your budget is, whether or not you can do anything additional this quarter, or if you have to wait till next quarter. Okay. So with proper books, you are going to be tax time ready. That's something, I love about bookkeeping, because instead of you having to rush and get your numbers together and calculate things and trying to figure out how much you spent in certain areas, with bookkeeping, you already have everything together. And so at the end of the year, all you have to do is press a button to create your profit and loss, and bam, you're done, right? So bookkeeping is also going to help you get funded. A lot of times when we have to apply for grants or have to apply for loans, they want to see your books. They want to see your profit and loss. They want to see your balance sheet. And so when you have a legitimate system in place, you're able to produce these statements easy and just hand them right over. Okay. And again, budgeting and forecasting, bookkeeping is going to help you do that as well. But most importantly, it's going to be that audit protection that you need, right? So, in the case if you were ever audited by the IRS about any type of expenses that you may have taken, if you just give them your books, they're going to see everything because it's detailed. So, you can say, yes, I did take this expense. Yes, it was a business expense. It was legitimate. I did it, this date. I did it for this amount and this is what it was for. You have all that information there. And so it really acts as a good audit protection as well. And that is something else that I love about bookkeeping. And so again, a couple of important statements that bookkeeping is going to be able to provide to you is going to be your profit and loss statement. Right, your profit and loss statement, it basically adds all the money up that you have made in your company and it subtracts all of the costs and the expenses. So you'll know if you came up at a profit or if you came up at a loss for that particular time. It's going to tell you how well your business is doing. So that is an important statement for you to run. All right. Secondly, is the business sheet. The balance sheet. I'm sorry. So the balance sheet is going to help you understand your overall financial health of your business. You're going to be able to see what your company owes. That's going to be what your company owns, which is going to be your assets, and what your company owes, which is going to be your liabilities. So if your end game is really to sell your business at the end of the day, you're going to have a good balance sheet because this is the statement that people are going to want to see. Your potential buyers are going to want to see your balance sheet because that's going to tell them, okay, it's going to give them the realty about your business to see how much it's really worth. And so you want to be able to keep an updated balance sheet to make sure that your numbers are all looking good. Okay. And then thirdly is your cash flow statement. Basically, your cash flow is just showing you how your money is coming in your business and how your money is flowing out of your business. And this statement is basically to make sure that you have enough cash coming in and everything is running smoothly. Okay. So you want to run these statements at least weekly. And then depending on how your transactions are looking, if you have a lot of transactions, then you want to do them at least monthly. All right. And then if you are just like, TK, I really don't have time, you want to really do them quarterly. But I suggest monthly, you looking at your numbers, looking at your profit and loss and your cash flow statement. Those are probably the most important ones that you should be laying your eyes on the monthly basis. Okay. All right. So another way to maximize your deductions and really get tax time ready, that is going to be to leverage your business expenses, right? So how do you leverage your business expenses? You do it through deductions and credits. Okay. So being able to really leverage these business expenses is not only a way to optimize your financial position, but you're going to reduce your overall tax liability. All right. So when I say the word tax liability, what I am talking about is your tax bill. So when you leverage everything that you have purchased within your business, and we know there is a lot of things that you have to purchase in your business, right? And so you're able to use those purchases to lower your tax liability or tax bill. And this is because the IRS, they provide you with deductions as an incentive, right, for business owners because they want you to continue to promote economic growth. That is what you're doing. As a business owner, you are stimulating the economy, and they love that, right? You're promoting job creation and you're promoting overall business development. So, because you are helping the economy, the IRS gives you tax deductions as an incentive, right? They want you to go ahead and create a business. They want you to go ahead and create different types of services so that you are continuing to stimulate the economy, right? But what is the difference between a tax credit and a tax deduction? So, a tax credit directly reduces the amount of tax you owe. It gives you a dollar for dollar reduction of your tax liability, that tax bill, right? So if you take a tax credit that is valued at $1,000, that is going to lower your tax bill by $1,000. So a tax credit could really potentially put money back to you directly in your pockets. Okay. So that's what a tax credit, but a tax deduction works a little bit differently. A tax deduction is going to reduce how much of your income is subject to taxes. Okay. So a tax deduction lowers your taxable income. Okay. And it lowers it by the percentage of your highest income tax bracket. So, how much could you save on a particular tax deduction? It really depends on where you fall at on the tax bracket. So, if you fall into like the 22% tax bracket and you have a deduction or all of your deductions are $1,000, then that is going to save you $220. Okay, so that's why people like tax credits a little bit more than tax deductions, because tax credits can potentially put money directly back into your pockets. All right. But how do you identify a deductible business expense? So how are you really able to say, okay, what is going to be tax deductible and what is not going to be tax deductible for my business? This is how you should be able to tell. Number one, you have to keep your business and your personal expenses separated. First of all, that's like business 101. When you first start your business, you have to go out and get a business account so that you're not commingling. Okay. Commingling is basically where you have everything coming out of one account and you don't know what is what. But when you have separated your business account, and you're maintaining your books, meaning you have a good bookkeeping system, you're going to know that everything that is in your business accounts are legitimately business expenses. All right. So if you have everything in there and everything is used for your business, now you have to go and familiarize yourself with first the common deductible business expenses. So that could be things like your supplies and your materials. If you are leasing a facility to for your business, then any type of rent payments or lease payments, those are going to be deductible. Any type of utilities that you have for your business, those are going to be tax deductible, and any type of business related expenses. So we'll get into that a little bit more shortly. But if you have business, if you're traveling for your business, that is going to be tax deductible as well. Any professional fees such as legal, accounting, if you have a lawyer, your tax preparation, all of those things are business related. So certainly they are going to be tax deductible. All right. And then if you're doing marketing and advertising, those are tax deductible as well. But the key is you want to make sure that you are keeping very detailed records of all of your business transactions and expenses. So this is going to include those receipts, those invoices and any supporting documentation that you may have. All right. So organization is going to be key to being able to deduct these expenses and do them accurately. All right. So next, right. Of course, the IRS have regulations. This is number three, guys. So, of course, the IRS has regulations for you because, when you're getting incentivized, there are people that would definitely abuse this. And so the IRS has regulations that you have to abide by in order to really take advantage of these tax deductions. So what I have experienced is, there's always two types of taxpayers. There's the one type that wants to write off everything under the sun. If they go write off the air that they breathe, they want to write that off too. And then there's other taxpayers that are very conservative. They are afraid to take a write off because they don't want to raise a red flag. So the key is for you to meet, or for you to find like a common ground, in between these two types of taxpayers. So you are able to take these deductions, but you just need to make sure that you are abiding by the guideline, because you don't want to miss any money and you don't want to overpay in taxes. You certainly want to, pay what you're supposed to pay, but you don't want to overpay in taxes and leave money on the table, right? So the IRS says that your deductible business expenses, that they must be ordinary and necessary for your operation of business. So what does that mean? That means that whatever you are trying to deduct, it has to be ordinary and necessary. It has to be something that is needed for your business. So you can't go purchase a yacht and say, well, I am doing all of my consultations. I'm meeting my clients on my yacht, and then you want to write off the yacht. Now, could you do it? Yeah, you probably could try to, but would you be red flagged? Absolutely. And you're going to go through the ringer trying to substantiate or trying to prove that this is something that is really ordinary and necessary for your business. So if you have a med spa or a wellness business, like, you would have to prove that the other businesses are operating with this. Like, are other business owners purchasing yachts to go and do their services on? Like, is this something that is ordinary and necessary? So you have to ask when you have like a high cost expense, you have to ask yourself, okay, is this ordinary and necessary? And then you also have to ask yourself, like, if I'm ever audited, will I have a tough time trying to prove this expense? All right. So, secondly, the IRS says that your expenses have to be ordinary and common and accepted in your industry, while necessary expenses are helpful and appropriate for your business. So, when you file your business taxes, each business has a business code, right? You may see that NAICS on your taxes. And what this code does, like, everybody has a code, everybody has this code and this number in their industry. Okay. And so this code ensures that the tax authorities, the IRS, have a clear understanding of the business industry that you are in. And if everybody else is taking the similar expenses, then they're comparing, other businesses and other expenses and write-offs that you are taking to other people that are in the same industry. So if you just come up, with a yacht, all of a sudden they're going to know, okay, yeah, this is not something that is ordinary and something that is necessary in this particular industry, because they're looking at your business code. All right. So you really have to make sure that you are writing off things that is going to be legitimate. Okay. So expenses must have a clear business purpose. If the expense benefits both personal and business purposes, you can deduct the business portion only. All right. So a lot of people ask, they say, well, I have to get my makeup done. I have to get my nails done. I have to get my hair done because I am going, I'm doing a presentation, or, they're doing something business related and it's legit. However, when it comes to trying to write off those expenses, it's a real gray area when it comes to that. So you really have to go back to the question and say, if I am audited, would I have a tough time trying to prove that, me getting my nails done every month, me getting my makeup done every month, me getting a new wardrobe every month, is this really necessary in my business? Is this something that is ordinary in my business? Because what the IRS says is they would tell you, okay, so for your event that you are a part of, or where you need, the hair, the makeup, the nails, everything done, after that event is over, What are you doing with the hair, makeup, and nails? Because then after that event is considered personal, right? And so we'll take the example, if your business is, you do entertainment and you are a clown, right? And a clown has to have the clown suit, they have to have the wig, they have to have the makeup. Once that clown is finished with their event, they take the makeup, the hair, and the costume off. But for us, when we're saying, okay, we're going to get our makeup and our nails and our hair done, after that event is done, then what are you doing? Are you still wearing the hair? Are you still wearing the nails? Are you still wearing the makeup? So if so, that's going to be considered personal. And so what I like to advise my clients when they ask me this, I ask them, is it going to be worth going to battle with the IRS to kind of prove that these tax deductions are legitimate, or you would get those things done anyway in your personal life. So most of the times I feel like, that is not going to be worth you trying to fight the IRS to get this tax deduction. So, but I'll leave that, up to the taxpayer. But for my experience and my opinion would be, not to write off those things, because it could potentially raise a red flag, and then you're kind of inviting the IRS to audit other things. So sometimes it's best not to write off those particular things, but anything else that is legitimately 100% business, yeah, go ahead and go for those things. Okay. So other strategies that you can use to lower your tax liability. We also have the home office deduction. So this is a good one, because this benefits you. This tax benefit allows self-employed individual and business owners to deduct certain expenses associated with using parts of their home for business purposes. All right. So it is two things that you have to look out for when you're taking this home office deduction. So when they first came out, when they first came out with this particular deduction, a lot of people were really afraid, because they kind of put more attention towards people that would take this home office deduction, because it was abused at first. A lot of people was just writing it off, but they were not following the criteria for this, right? So this means basically, the first thing is you have to have exclusive and regular use for this. It has to be a designated area in your home, and it has to be just for your business purpose, right? So that means it cannot be at the kitchen table. It cannot be, in your bedroom. You have a laptop. It cannot be in the living room. It has to be something that is dedicated just for your business only. Okay. And it has to be a principal place of business. It can be used for your meetings, for your clients, for your customers, or for your patients, whatever it may be, but it has to only be used for your business. And it has to be a principal place. So the home office should be the primary location where your business owners conduct administrative management activities, and should be no other fixed location where significant business activity occur. So that means that if you have a home office, I have a home office, and then I have a business office too, where I do meet my clients. And sometimes at my home office, I meet with clients through Zoom. But my principal place of business is actually my office. And so I have to make a determination and say, okay, I cannot take the home office deduction any longer, because my home office is not my principal place of business. Although I do a lot of work at home, my physical office is my primary location. So you have to decide, where are you doing business at. If you're doing most of your business at home, then yes, you can take that home office deduction. But if not, you just need to not take the home office deduction if you are not legitimately doing all of your business at that location. All right. So another thing is that there are two ways to write off the home office deduction. You can take the simplified option. This is where you would just take the max of 300 square feet, and then it is $5 per foot, and then you're able to write that off. Or you can take the regular method. The regular method is where you would use a percentage of any type of mortgage interest, property taxes, rent, utilities, home maintenance expenses. The percentage is going to be determined by the portion of home is used for the business. So if you're using like 5%, 10%, 15% of your home for your business, then you're also able to take that percentage off that you are paying in property taxes, rent, utilities. You would be able to take off that 10%, 5%, or whatever it may be off on those bills and actually write them off too. So the home office deduction is really not a huge red flag anymore like it used to be, but you still need to follow the criteria to make sure that you're not raising any red flags. And if in the case if you did get audited, just have all of your records and all of your resources proving that you have a legitimate home office. All right. Moving on to depreciation and section 179 deduction. So these are really, really good methods to use to maximize your taxes. Okay. So when you are a business owner and you buy property or if you buy any type of machines, these are considered making capital investments, all right? And these assets are reported back to that balance sheet that we talked about earlier. All right. And so regarding your taxes, the cost of the investment is written off over time. So that is depreciation. When you buy, if you're buying like tools, if you're buying machines, if you're buying things that you need in your business, if when you buy these assets, you're able to depreciate them. You're able to write them off over a couple of years, depending on what the useful life of that property looks like. But it's going to give you tax relief in your business for it could be over 3 years or 5 years, depending on exactly what that asset is. So depreciation is a tool that a lot of entrepreneurs just don't use, but I don't know why, but it gives you great incentives back on your taxes. And then secondly is section 179. So how depreciation kind of gives us the opportunity to write off an asset over time. Section 179 gives us the opportunity to write off that asset entirely in the first year. So that is good, right? So, but the asset has to be used more than 50% in your trade or in your business to be written off like that. But section 179 is a good method, is a good strategy to use if you are buying equipment, if you're buying tools, if you're buying machines in your business. All right. So next is going to be continuing education. That is a huge expense that a lot of entrepreneurs have. We know that we have to be able to continue to invest in ourselves. And so the IRS knows that. They know that, you need training, you need to be able to enhance your skills to keep your business up and running. And so they offer you this as a tax deduction as well. So some of the things that you can write off is going to be your tuition, your fees. So anything that is costing you to enroll into certain courses or workshops or seminars, these are going to be tax deductible. All right. So again, it has to be directly related to your profession, though. All right. So you're also able to write off the expenses for your books, for any supplies, equipment. You're able to write off any travel if you have to go out of state to take your classes or your continuing education program. This is going to be deductible as well. If you need to get any type of lodging while you are, while you're going to your program, it's going to be deductible. Then any type of conferences and seminars, your registration fees that are related to your conferences, your any type of conventions. All of these are going to be tax deductible as long as it's going to contribute to your professional skills, okay, to your business. Then they are going to be tax deductible as well. And then, of course, if you have to pay for the certification, if you have to pay for the licenses, these are going to be tax deductible too. So again, it goes back to keeping good books with your bookkeeping so that you have all of your receipts. You have everything laid out, what day it was, where it was, what was the name of the company. All of that stuff should be laid out within your books. All right. So next we have deducting mileage expenses for your business. This is one that a lot of entrepreneurs also overlook. And the thing is that you have to have a driving log, like somewhere where you are writing down where you went, the date, the mileage on your car, how many miles was it from, like how many miles did you drive? Like all of those things have to be documented too. And so again, is the IRS is giving us a lot of opportunities, a lot of benefit, but it all goes back to documentation, right? Documentation is going to be your best friend when you are an entrepreneur. So if you are using your vehicle for business purposes, then you are able to deduct mileage on your tax return. So there are guidelines to being able to claim this deduction, but and that is if you yeah. So right now, I think for last year, you are able to claim so for per mile, it is 65.5 cents per mile. And this is from if you are, let me see, so from your business to doing work related, those miles are deductible. So from your business to any type of work related activities, those miles are going to be tax deductible. Okay. So if you are running any type of errands, if you're going to the post office, if you're going to see one of your clients, if you are driving to one of your, to meet your mentor, if you're driving to to a conference, all of that is going to be tax deductible. So again, you have to record it though. And so if you have not been recording it for 2023, you can try to go back and look and see, but just go ahead and make a physical document to where you can see where you drove and how many miles it was. Again, just in case of an audit, you have your backup, you have your proof already. Okay. So there are two different ways for you to write off your business miles. All right. So the mileage deduction is for business related travel. This includes any trips to meet clients, business meetings, travel between different work locations, and any other work related journeys. So there are two methods for you to calculate your business mileage deduction. The first one is going to be your standard mileage rate. So the IRS sets a standard mileage rate, 65.5 cents per mile, that you can use to calculate your deduction. And then also you can use, well, not also, because you have to use one or the other, but you can use the actual expenses. So you can deduct the actual expense associated with your vehicle. That would include any type of gas, maintenance, depreciation, and other expenses. However, the method requires more detailed and record keeping. So if you like, look, TK, I ain't got time to do all this record keeping, then you just may want to take that standard mileage rate, okay? Because you want to make sure you have all of your ducks in a row when you are taking these expenses. So if you're not very detailed about it, then just go ahead and take that standard mileage deduction where you would get 65.5 cents per mile, okay? Then regarding more travel, those the travel expenses. So your travel expenses is going to include any type of airfare. Like again, we just stated the mileage. If you are renting cars, also lodging, the meals, any incidental expenses directly related to your business purpose. So keep in mind, all of these tax deductions that we're talking about today has to be directly related to your business. All right. So how do you take these expenses? Keep thorough records of all of your expenses. You want to keep the receipts, you want to keep invoices, you want to keep boarding passes, and any documentation that is going to substantiate your expense. All right. So the IRS requires you to keep these detailed records for each expense claim. So even if you have, like, emails going back and forth about a trip that you may go on and you have to do some type of business there, like, you want to keep all of your emails about that. You want to keep detailed records. You want to keep like a schedule. If you have like an itinerary of what is happening while you are on this trip, then you want to keep that too, and just make it all like one thing, so that in the case you're ever audited, like, you have your proof, you have your evidence of what has actually happened. Okay. So another strategy that I love too is being able to put your family to work. A lot of people love this strategy, and it really helps you maximize your tax deductions, and it also helps you save on your taxes, that tax liability or that tax bill that we have talked about. And I believe everybody needs to work. Everybody, the kids need to work, the spouse needs to work, the parents need to work. And there are a lot of benefits from this. So there's an additional tax benefit for hiring your kids before they turn 18. First, the income is tax free up to the standard taxable amounts, which is $13,850 for 2023. So if you put your kids to work last year, then you have to know that you are able to pay them tax-free up to $3,000, 850. And so your kids will be exempt from any type of FICA taxes, and that is your Social Security and Medicare, since they are working for a parent-owned company. Yes. So put your kids to work. They need to do something too, right? So what does it look like when you hire your children? So let's say that you decide to hire a 16 and 18-year-old, and they're going to work for you over the summer, and they work for you for 12 weeks. You pay them each $5,000, and you are able to subtract $10,000 from your business income, which means less money gets taxed. So if you're taking out $10,000 paying your kids, then you're not taxed on this $10,000 that your business has made, right? So what happens is you can give your kids $10,000, or you can put the $10,000 into an account, and you pay whatever they need throughout the year. It could be, school supplies or whatever you spend money on for your kids, but you can put that in a bank account. And as far as your business, this is money that you're not going to have to be taxed on. So that's awesome. So what's even better is that your children won't have to pay any federal income on what they earn, because they are below the standard tax deduction threshold. So if you are trying to do that this year, look and see what the standard tax deduction is for 2024, and then know that you have to be under that number for them to avoid to pay any type of FICA, any type of federal income taxes. All right. So putting your family to work. And then another thing you can do is setting up a Roth IRA for your kids. Even kids can start saving for the future as they need to with a custodial Roth IRA. So as the parents, you can put money into their Roth IRA up to what they earn, but it can be no more than $6,500. This was back in 2023. This helps their money grow over time, guys. And when they retire, they can take this money out. They can take the money out without paying taxes on it. So this is a great opportunity for you to start building the generational wealth that you have that you've been talking about. This is how you go about doing that. Go ahead and put your children on payroll, and then go ahead and set up a Roth IRA for them, right? So the thing that you have to consider is that you have to legitimately put them as an employee, right? Because we want to do things accurately. We want to do things how we are supposed to do it. And so you want to be able to treat them as an actual employee. Okay. So let's talk about hiring your parents. So imagine you have a business and your parents are retired and they want ways to stay active, right? Like my mom. Yes, I have my mom a part of my business, and yes, it works. So you decide to hire them part-time, paying them each $10,000 a year. This choice comes with benefits because you can subtract the $20,000 from your business, again, lowering that amount that you would have had to pay taxes on, that you're going to be taxed. What's even better is that your parents won't need to pay Social Security or Medicare on those earnings if they are over 65. So this is another great strategy for you to take advantage of, get your parents to working too, so that, they have something to do. It's going to keep them active when they are retired. All right. So another person we need to put to work is the spouse. And I have not put my spouse to work just yet, but I'm still working on it. So when your spouse comes on board to work with you, there are tax perks that you can enjoy as well. So one of them is to being able to deduct the expense of your spouse's health insurance premium as a business cost. So this would apply to you if you offer insurance within your business. And then if your business is a sole proprietorship or a partnership, you'll get to deduct the entirety of your spouse's wages as a business expense. Again, helping you to cut down on your taxable income, right? So those are beautiful. Okay. So putting your family to work, there are a couple of things that you definitely need to be mindful of. One is being able to maintain their wages. Okay. So you cannot overpay them and you don't want to underpay them either. So you want to maintain fair wages and working conditions. Like I said, like you still have to adhere by the labor laws and the regulations, and especially with your kids too, if they are younger children, like you have to abide by the labor laws. Okay. So another thing you should do is keep accurate records and documentation as always with any tax deduction or credit that you're trying to do. You need to make sure that you are keeping good records, and you want to avoid conflict with interest and nepotism as well. So again, just like with any other employee, you should provide your family members with good wages and reasonable working conditions. You want to pay them according to their skills, according to their experience, and the value that they bring to your business. All right. So be mindful of the minimum wage laws as well. You really can't pay your 10-year-old $100,000 a year just to answer the phone, right? So you want to make sure that the wages is matching the description. And do know that the IRS, they really scrutinize wages paid to family members. So be sure to set up a compensation at a fair market rate for the work that they perform, right? So again, you want to comply with the labor laws, such as the working hours, overtime, and you want to ensure that you have all of the necessary permits, especially if you are hiring minors, and follow child labor laws pertaining up to the age group and the work environment. All right. So also, when you are hiring your children, I want to make sure that I tell you that you have to have them as an official employee. You want to make sure that you have a written description of their job. You want to maintain the hours that they are clocking in. You want to properly file tax forms, like a W-2, getting all of their information. And you want to maintain a separate accounts for your child's income, right? So that you can be able to demonstrate financial transparency if you were ever, questioned by IRS, right? And so again, what you can do is, like, if you have like a 10-year-old, I have a young child too, she's 12. And so for her, like, I would make her a description of what her job duty is. Maybe it's just to come and clean the office, make sure all the paper is, picked up neatly, make sure everything's filed away. or if she is organizing folders. Like, I would make a description of what her job duty is, what her pay is, how often she is paid. Like, you want to be very detailed as possible when you are putting your family to work. All right. And so my last strategy for you today is this: to find a professional that fits your business needs. All right. So according to, and I say this because I hear so many stories every year, about how taxpayers, entrepreneurs are being connected with, tax professionals, and they feel like, okay, yeah, this is going to be a good fit for me. But then they're ghosted. Like, maybe something is wrong with their taxes, or they were trying to get their taxes filed, and suddenly the tax preparer just, like, totally left them, and they're stuck there with either unfiled taxes, or they have issues about their taxes, or they may even have questions about their taxes, and they cannot find the tax preparer. They're nowhere to be found. I had one tax client. She went back to the building that she met the person in, and the entire building was just dark. And so, in order for you to do that, in order for you to avoid ghost preparers, what I want you to do is check qualifications. And when I say check qualifications, like, you want to make sure that your taxpayer has a P10 number, all right? And that means that every taxpayer that is going to take compensation from you to prepare your taxes, they have to have a P10 number. And this rules and regulations for tax preparers to maintain this P10 number, right? So you want to make sure that they have qualifications. It's no harm in asking and saying, hey, do you have a P10 number? Because you want to make sure that you have a reputable tax preparer, right? So other things that you can ask is, you can ask about their history. How long have you been doing taxes? You want to ask questions. There's nothing wrong with asking questions, and that is a good question you want to ask. You can even ask, do you have any referrals? Is there anybody that I can talk to that you have done business with? I want to be able to make sure that I'm connecting with a good preparer. And something else you need to ask about is the service fees up front. Ask about that up front, because you want to avoid preparers who base their fees off of percentages of your refund. You cannot, taxpayers are not allowed to do that. They are not allowed to look at your refund and say, oh, well, it's going to be 10% or 15% of what you get back. That is not proper etiquette. That's not proper. That's not a proper way. It's not ethical for a tax preparer to do that. So you have to get, you can ask for a fee up front, and they may tell you, okay, well, my fees start at blah, 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 because they may charge you by forms that they have to put in for you, and each form may be a certain price. So that's fine. But if they were ever to tell you, well, yeah, I do my pricing based off how much you're getting back, nope, that's a red flag. You need to avoid them as a tax preparer. Okay. And so another thing you want to do is ensure accessibility. Like the story I just told you, you want to make sure that your tax preparer is going to be accessible throughout the year. All right. So with us at our firm, we are available throughout the year. We don't shut down after tax season. Okay. So we are a full-fledged firm. We work January all the way to December. And if there are any months in between those, we work those too. So you want to make sure the person that you are linking up with is going to be accessible to you, someone that you can get on the phone and ask questions to. Ask questions. There's nothing wrong with asking questions. So you want to be comfortable. You want to feel comfortable with the person that is handling your business, because doing taxes, that's very personal, right? And so you want to make sure that you feel comfortable with asking questions, and that you're able to get an answer back. All right. So the last thing I want you to consider is consider specializations. You want to ask and make sure that your tax preparer is specialized in a certain area. For me, when I have a client that wants something that is outside of my scope, I tell them, look, I am not experienced in this area, but I will refer you to someone that is, because you want to have someone that kind of is specialized in your particular tax filing or that has experience with filing those particular taxes, such as small business taxes. I told you the story about when I started my first business. My tax preparer was not experienced with business taxes. And so therefore, she did not ask me any business taxes related questions. And I was shy and I thought, I'm a business owner. I'm supposed to know everything. And so I didn't ask her, or do you do business taxes, or are you taking my business expenses into consideration? I didn't ask those questions. And so I ended up owing that first year. And so again, it's imperative for you to make sure that your tax preparer is specialized or experienced in your area or your field, right? You want to make sure that they at least have business tax experience, right? And so you want to choose someone that is going to specialize in the needs of the things that you need to be addressed. All right. And so before I go, I just wanted to address some things about the BOI reporting, so that you're not, totally left in the not in the know about this that is coming up. We had a lot of questions about this. So this is what they're trying to do. They're trying to curb money laundering, frauds, illegal activity. And so they need for everyone to do this beneficial owner report about your business. So who is the beneficial owner of your company? So that will be the person who has the most control over your company, the person that controls at least 25% of your company. So that person will need to go and fill out this information. So if you operated, or if you're going to be operating your business after 2024, so if you're going to open a new business, then you are required to make this report, right? You're required to do this 90 days after you have received the actual public notice that you have created and registered your business. So you have to file. This is going to be your initial BOI filing report. So if you're intending on, starting your business, then you have to make this report by 90 days after you have registered, right? So if you already have your business, like most of us that are probably on this webinar, you already have your business and you've had it prior to January 1st, then you have until January 1st of 2025 to complete this registration. So I know a lot of people are trying to charge for this, and they're trying to put in sense of urgency on it. But if you have already had your business, then you have until next year to actually file this registration. Should you do it as soon as possible? Yes, of course, but it's not a like I've seen some posts where people are saying, file this or you're going to have to pay a fine, or, you could go to jail. They're trying to like scare people into doing it right now so they can get paid to do the service. But if you have already had your business, just know that you have until January 1st to actually complete this. Now, again, do you need to do it soon? Yes, do it soon. But I just want you to be aware of, people trying to do a scam and trying to make everything a little bit, more urgent than it really is. And another thing that I wanted to tell you is that right now we're coming upon the annual registration, and that is where you have to go and you have to update your business, right? You have to go and pay for your registration to make sure that your business is still compliant. And what I see is there is a company that sends out a letter. If I had a copy of it, I should have showed you this, but there's a company that sends out a letter, and it looks like it's from the state, and they're telling you need to register. Your registration deadline is coming up, where it probably is because they have access to see when your business registration needs to be renewed. But with this letter, they're charging. So everything looks legit. And then they say, you have to go online, but the fee that they're charging is I think it's like over $100. So if you get a letter like that, just know you want to make sure that it's definitely from the state. So I know what the ones from the state of Georgia look like, but I'm not sure about other states. So if you get a letter like that, just make sure that it is legitimate. And for those of you who live in Georgia, you can definitely go on to the Georgia website and go ahead and renew your annual registration. So just to be safe, make sure you're going via the Georgia annual registration site to renew your business registration, and that you're not going to this letter to the website of this letter. But I don't think it's more than $100. I could be wrong, I'm not sure, but just make sure if you're getting any kind of correspondence from a company that is saying, hey, you need to do this and do it now, or you're going to be charged, blah blah blah, double check and make sure that it's from your state. All right, because I get that letter every year, and I had one of my clients get that letter, and I was like, no, this is not legitimate. Go to the state's website and just do it from there, because they're trying to like charge you more than what you really need to pay when you can just go to the Georgia website. And I'm sorry, I think I went off on a tangent, but I do that sometimes. So I am going to be closing out. And if you have any questions, or if you need support in any of these areas, you are able to contact me at hello@tkbarlow.com. And again, we would welcome you on board the Barlow train. We do business tax prep. We do personal tax prep, monthly bookkeeping. We also do monthly bookkeeping cleanup, and we also do payroll. And you are able to scan this code and get directly to my calendar. If you want to go ahead and get on my calendar, we can go ahead and take you, if you want to get on the calendar. And so if you have any questions, you can feel free to email me. You can email me or get on the calendar, whichever you prefer. You could drop a question below. And if you are watching this on the replay, I would love to know where you're from and what your business is. So drop me a little note, a little message, and I'll be sure to get back to you. And again, guys, I thank you so much for being a part of for just being a part of this webinar, just listening to me rant about stuff. I appreciate it. And I look forward to seeing you on the calendar. In the meantime, cheers to your success, and I will see you soon. Bye-bye.